And our next guest says while recessions are typically bad for small caps, this time things are different. Joining us now is BoA Securities' Carey. Jill, great to catch up with you. What might be different about the setup here when it comes to the small versus large equation?
You start having me. Well, I think, recessions overall are not good for equities, but I think there's some supportive fundamental factors for small caps this time around. And I also think that you've largely seen the risk get discounted into small cap valuations, at least more so than we've seen for large caps. Small caps right now are extremely cheap versus history on a bulk of the valuation measures that we look at. The forward price to earnings ratio is trading at similar levels to prior recessionary lows, even some of the more severe recessions. We're trading at about 12 times forward earnings for small caps right now. When you look at the S&P 500, obviously not even cheap versus history. The relative discount of small versus large caps is almost as large as we've ever seen. So I think from a multiple perspective, and when you look at how much small caps have typically declined during recessions, the recent peak to trough decline we saw was, almost typically what we see. Obviously, we've seen a risk-on rally since July. So, if recession becomes increasingly priced into the market, we do think there's more downside risk to equities overall. But we think there could be more downside risk actually to large caps than small caps at this point. And I think what's been fundamentally supportive is that, small caps are more exposed to services than goods spending, so similar to the makeup of the U.S. economy. And that's where we've seen the relative strength recently with, more upward revisions to services exposed areas generally since March versus downward revisions to goods. And, you've seen the upside surprise in the ISM services. So I think that's one fundamentally supportive factor. The other surprise that's come out of earnings season has been CapEx spending has held up very well, and CapEx guidance has been relatively strong. And small caps generally tend to do better in terms of how correlated their sales are with U.S. CapEx cycles than large caps. They tend to be relative beneficiaries there.
Yeah, smaller companies, essentially often the vendors for very big ones, I guess, in that case. I was thinking about prior market cycles when we talk about how small caps behave in recessions. And, the early 2000s bear market, which did have a recession associated with it, small caps really did outperform quite a bit. I wonder if that was mostly about the very largest, kind of overvalued stocks underperforming in that downturn, or if there was something similar going on there where small caps had just kind of discounted the worst.
Well, I think, there were a number of parallels between today's market backdrop, going into the recent recession fears versus what we saw during the tech bubble period with obviously a lot of the, tech-related types of stocks, non-profitable stocks. We saw the IPO boom last year and really the 2020 to 2021 IPO boom was similar to what we saw back then. A lot of non-profitable companies going public. There are a number of the democratization of investing, as we've called it. Mm-hmm. So I think there's been a number of parallels to the market then versus now. And that ended up, being a great decade for small caps from, the tech bubble period in 2000 up till the global financial crisis. Small caps significantly outperformed large caps, and that was really the only other time that valuations on a relative basis were as cheap as they are today. So, the fact that small caps are cheap, valuation we found doesn't tend to tell you too much about what, an index is going to do over the next several months or next year. But if you're a long-term investor, we found a very high predictive power of, what the PE ratio is today to what returns are over the next decade. So for long-term investors, we think certainly, valuations would suggest you could see better annualized returns over the next decade for small caps than large caps.
And what would seem to be a good vehicle or, style to pursue if you wanted to capture the parts of small cap that seem like they're well set up?
Yeah, I think, even though last month in July, it was definitely a, risk-on rally and lower quality stocks outperformed, for most of the past year and a half, what we've seen in the market has been a focus on quality. So, like I was speaking about earlier, how we've seen a lot of, non-profitable companies going public and getting added to the index. Stocks that have earnings that are higher quality, more stable earnings, are the ones that have generally been rewarded within the market. And that's one of the reasons that healthcare, which, a lot of that is biotech, has been one of the biggest underperformers within the Russell 2000. There's still a lot of non-profitable companies within that sector. So small cap healthcare still screens relatively weaker in our work. Versus focusing on quality areas that have more stable earnings. I think dividend yield, which is something that may often be overlooked within small caps. Investors may not typically be buying small caps for their dividends, is a factor that has been strongly outperforming within small caps over the past year and a half, and this year. So especially if you're in a backdrop of lower price returns, focusing on total return and dividends is important. And then lastly, value. I think small cap growth still looks a little expensive versus small cap value. Value tends to fare better than growth within small caps during economic recessions if there is risk that we are going into one. So we'd focus on value, stocks with strong free cash flow and quality. The S&P 600 index, which is higher quality than the Russell 2000, has been outperforming this year.
Yes, absolutely has outperformed. It is the quality, profitable stocks within small cap. Jill, thanks very much. Appreciate it.
Thank you.